Aloha, good morning. This is Caron B Davis of Caron B Realty International. Aloha Friday. And today we have Duncan back from the president of Infinity Financial. Welcome back,
Hi,
Duncan.
everybody.
And yeah, and I love having you on our show because you're very analytical. And I know right now when I'm pricing properties, I get very analytical. We were just pricing a property the other day and looking, okay, this is the prices today, where is it going, supply and demand, price per
Right.
square foot. And it's interesting, as you dig deeper you find the answers, even though no one can really tell what's going on. But I believe, and you're a real numbers person, and that's what I'm going to enjoy about today, because I need to get updated with the mortgage industry right now. And so tell us what's going on.
Mortgage rates hit a new multi-decade high the last couple of days. The average mortgage rate actually hit over 8% nationwide. And they've been trending higher. And it seems like they have been moving up so much higher. But looking at it versus a year ago today, rates are only 0.6% on average higher than a year ago. So they've hit multi-year highs with an average for the first time in decades over 8%. Um, I think they're likely nearing their peak. There's a lot of fundamental reasons why rates are likely nearing their peak. They are trending higher, so they're likely to go a little bit higher, but we're not likely to go beyond the lower eights on interest rates. We had that huge pandemic surge in the money supply with government spending and paying people to stay at home, and the Fed buying back long-term mortgages and bonds at the lows when interest rates are really low. And now it's in reverse, where money supply is decreasing a lot. So the fundamentals are changing, but you still have a supply and demand situation where you have the government selling bonds because they need to borrow money to fund the deficit, all this deficit spending from these big bills that they had during the pandemic. So you have the government trying to raise money, and it's supply and demand in the bond market. So when you don't have enough buyers to soak up all that supply of bonds, when the government is borrowing more and more money, the rates go higher. And so that's what we're seeing, that supply and demand issue. And you have hedge funds that are short treasuries, long-term treasuries. So we have a record short position, meaning that they are betting on the bonds going down and rates going up. So you have a record short position by hedge funds. So those factors are combining to move rates higher on the long end. We have the Fed that controls the short-term rates. They're nearing the end of their rate hiking cycle. They've said that they're nearing the end. They may be done with their rate hikes. They may have one more 0.25% rate hike. Looking at the futures markets, most people are expecting them to either be done or maybe do one more rate hike in December. We've had an inverted yield curve where the short-term rates have been actually higher than the long-term rates, because a lot of investors were expecting a recession by the end of this year. But all the economic reports have been pointing to the economy being much stronger than people expected. So that yield curve, where the long-term rates were much lower than the short-term rates, that's starting to flatten, where the short-term rates are staying about where they are, because the Fed is pretty much done with the hiking of the short-term rates. And the long-term rates have been rising to get closer to where the short-term rates are. So that inverted yield curve is starting to flatten up with the long-term rates coming up. So that has caused the mortgage rates to go up. One of the factors is that the mortgage rates trade at a premium to the bond rates. The 10-year Treasury mortgage rates have usually been under 2% higher than the 10-year Treasury, but recently they've gone closer to 3%. So that with the fluctuations in the market, you've seen a lot of a higher premium on the mortgage rates, and that will come back over time. So even if the long-term rates continue higher, mortgage rates may not continue higher as much as Treasury rates. So we're getting close to the top on mortgage rates by Q1. Within the next quarter or so, we should see the peak of mortgage rates, and we should see rates coming down next year. So inflation, if you look at the fundamentals, one of the recent reports showing the strength in the economy was a payroll report that for the August payrolls, it showed very strong payroll numbers with many jobs being created. But if you look at the underlying details of that report, it was actually much weaker than the headline. Headline numbers showed 336,000 new jobs being created, but most of the jobs, actually more than that number of jobs, were created by the government. From all these bills that were done during the pandemic, a lot of that money is flowing down to the state and local governments, and they're doing a lot of hiring. And a lot of the jobs that were created were also part-time instead of full-time. So if you look at the underlying details, it was actually on the private sector was a big loss in jobs, and actually the biggest loss in jobs since the pandemic.
Interesting.
So even though the headline numbers and headline reports show a big, strong growth in labor, we're going to start seeing more and more weakness in the labor reports going forward, and more signs of a recession and a weaker economy. Because if you look at the underlying details of the reports, the economy is much weaker than what the headlines show. We have a number of factors that are contributing to tightening up the money supply in the economy. Money supply has been dropping since early last year. And we need to, over the long term, you need money supply to be at about 5 or 6% rate to keep a 2% inflation rate, which is what we've had for the past decades. But we had this huge increase in money supply until early last year that has peaked and come down. But there's a lag in the effects of money supply and how that affects inflation. So inflation started coming down later last year and came down from the 9s to the 3s. And it's not going to come down in a straight line. So it's still hovering in the 3s. And we've got to get it to the 2% level that the Fed targets. And we should see that next year with the money supply decreasing so much. So we've got a number of factors coming in now. Primarily, we've got the banking crisis with the tightening of banks and lending, the higher interest rates. We had the student loan payments resuming this month. So that is adding to the tightening. People are having to take money and use it for student loan payments, so they can't use it for spending in the economy. So all these different factors are tightening up the economy, and we'll see that reflected in the reports that we get from the government. And those reports will force the Fed to stop hiking the rates. And the other thing they're doing is, instead of where they were buying long-term bonds and mortgages a couple of years ago when rates are really low, now they're selling them, which is with quantitative tightening instead of quantitative easing. So these factors of the government and the Fed both selling bonds, making rates go higher, long-term rates. That's kind of part of doing some of the job that normally the Fed would do in hiking the short-term rates. We're seeing the long-term rates come up, and they're nearing where the short-term rates are. There's not a lot more upside to go, especially if the Fed's done hiking. So I've got a bunch of charts that show this, but basically we're nearing the peak in the long-term rates, and we should see them move lower next year. And we may see them move higher for a little more, but we should see the peak within this next quarter.
So they just raised the rates a few days ago. I know they were talking about waiting for some reports to come out when I was reading an article last week.
So the Fed actually did their last rate hike. They did not hike the rates since, I think it was July was the last time they hiked the rates. But they had a meeting that they talked about hiking the rates further, but they did not make a move to the Fed funds rate. But a lot of the Fed board members have been giving talks and talking about possibly raising rates and keeping rates. The phrase that they like to use is keeping rates higher for longer. So a lot of people expected the Fed to start cutting rates earlier, but now the expectation is that they're going to keep the short-term rates higher. So the long-term rates are coming up to get that yield curve flatter to reflect that expectations of higher rates for a longer period.
So how about, I know as we've talked about, there's always different loan programs going on depending on what's going on with the economy and the interest rate. So what is the best program available out there, I suppose, if somebody was going to say they've decided they'll just hold on to this home for 7 years and they might get transferred. I mean, what would you recommend?
Well, depending on what the qualifications of the buyers are, there are different loan programs. One of the best programs always is a VA loan for those who qualify. And one of the reasons a VA loan, I have a borrower right now who is buying a 2.5 million place, and they're putting $1 million down. And normally you would think with so much down, such a big loan, they might want to go with a normal jumbo loan, but they're going to go with a VA loan in that case because the rate's a little better on a VA loan, and it's so much easier to refinance a VA loan than it is a conventional loan. You can refinance a VA loan without an appraisal, without any income documentation. So those who can qualify for a VA loan, that's the best loan to get for the primary residence in this market. And for those who can't, there are other options to help to ease the payments. I have another borrower who wanted to have lower monthly payments for the first year or two, and they're likely to get a chance to refinance within the next 2 years, year to 2 years, when the long-term rates do come down some. And so there are a couple of options that you have with a temporary buy down, where you can do a 2-1, 3-2-1, or 1-0 buy down, meaning that your interest rate is reduced by 1% for 1 year, or 2-1 is 2% for the first year and 1% for the second year. And that's done using the seller credit. So if you are negotiating buying a place and you want to have a lower monthly payment for the first year or two, then you can just negotiate a seller credit. You can offer a little higher than you normally would. And then that seller credit can be used to lower the monthly payment and lower the interest rate for the first year or two, depending on which option is chosen. And that's
And I
getting
think,
more and more popular in a situation where we're nearing
yeah,
the interest rates.
yeah, and I've seen a couple of our agents use that actually. And, I think it brings back, it's so important to work, with a good mortgage broker and yourself as you look at properties and go, okay, how do we put this together? How do we buy this? And, somebody once said, when we had all the lower rates, of course, and someone's in their home, people say, oh, we'll never have any listings to buy, any property to buy, because why would you sell your house if it's under 3% or under 4% even? But the reality is, as they say, life happens. People move, yeah. People have children, people want a better school district. So people's motivation isn't all about the interest rates usually. It's about their personal circumstances, of course. And with
Right.
that
We
is
do have
like,
much lower volume.
Sorry.
Yeah, we do have much lower volume and far fewer sellers and buyers than normal, because a lot of the buyers can't afford the
Yes.
current rates, but a lot of sellers don't want to sell. So a lot lower inventory. So that's kept the prices in balance. So some people were expecting prices to crash or drop a lot, but because there's not much inventory, and you have such a big demand, you have two of the largest generations ever, or the two largest generations ever, wanting to own homes at the same time. So a lot of fundamental reasons for there to be so much demand. Even when when rates go up, you still have a lot of buyers and multiple offers on good properties. So
I know.
it's really interesting market. Yeah.
It's very interesting. It's like, I was mentioned, there was a Park Lane sale last week for 27 million, right? A penthouse. Yeah.
Right.
And then if we take even Manoa, I noticed a house went into escrow that was listed at 5.3 million, right? We've never seen that really before in Manoa. Right. And then I have a listing there on Oahu Avenue, and I've got more inquiries now than I did 6 months ago, which is amazing.
Yeah.
So I've got we'll be closing next week, but I've had 6 people on the finishing line saying, well, if something happens, please give me a call because I have a client interested.
Yeah. You still have a lot of people that want to buy, and it is a good time to buy if you find a great property, even though the rates are higher, and even if you need to borrow a lot, because if you wait for rates to drop, some people say they want to wait for rates to drop, but then you're going to have so many more buyers, especially on the lower end where you have people that will be able to qualify for what they're looking for. And so you might be able to wait on a property, and maybe the list price, if it stays the same, or even if it drops, you're going to get a lot more bidders on properties when rates come down. So if you find a property that you really love, it's a great market
Yeah.
to be able to not have as much competition, and then you could always refinance in a couple of years, or whenever it makes sense for you to refinance.
Yeah, and I think, that brings back the point, working with a real estate broker, people really need to work with somebody who's a little more numbers orientated, and definitely can think through these critical thinking for clients and help give them options, have resources, vendors for different things, not just like, oh yeah, let's buy this property. There's a lot more that goes into it now, of course.
Yeah,
and
exactly.
a question we haven't talked about this for a while, but how about somebody who wants to get a home equity line of credit? What are those HELOC loans doing lately?
Yeah, this is the period where people have the highest equity in their homes. It's much higher than
Yeah.
10 years ago, or 20 years ago. People have a lot of equity. If they can qualify, then it makes a lot of sense to use a HELOC. You can keep your first mortgage, and you can do a HELOC to get money out if you wanted to buy another property, because a lot of people, the average loan to value ratio now is about 42%. So a lot of people have a lot of equity,
Oh, yeah.
and they can use that to invest in other properties. So we have a couple of new HELOC products. One is what they call a 5-day HELOC, where you get an online approval, and it's very fast. And if you're in escrow, for example, and you need to close really quickly on a HELOC, I know a lot of the local lenders will do HELOCs, but they can take 2-3 months to close on a HELOC, and that wouldn't work in an escrow time frame. So we have this new HELOC product. The rates aren't the best, but it's really fast, and it's fast and easy way to access your equity. You do an online application. If you have a simple situation, they don't even need any documentation, and they don't need an appraisal. So it can be a much faster way to access your equity when needed. We have even for people that don't qualify on traditional ways, we even have bank statement HELOCs, where you can, or second mortgages, where you can use your bank statements. If you, for example, are self-employed and you write off a lot in your taxes, your tax returns don't show enough income, you can use your bank statement to show that income. You can do that both for first mortgages, and now we can do it for second mortgages and HELOCs as well. So for people that don't have the traditional qualifying, but they get enough cash flow to qualify to pay, then we can not even using any tax returns or pay stubs or anything like that, just the bank statements, using that to qualify for a second mortgage or a HELOC, to use that equity that people have built up with values increasing over time.
Well, I could sit here and talk forever about all this, but I know we both got appointments to go to, and people, I thank our listeners today. And of course, we end our session every week with Marianne's photos, and I'll pop those on. And today she was like ending week on a very lighter note, and she was saying, peekaboo, have you ever seen a yellow duck in Hawaii? They're just gorgeous, her photos. Wow.
Yeah.
But this mama duck, she said, had a brood of 6 ducklings and 4 brown and 2 yellow ones. The other ducklings are all napping underneath the mother duck here, she mentions. And just going on to our next photo here. Oops, let me just, had a malfunction here. Oh, there we go. Butterfly is a symbol of transformation, rebirth, hope and freedom. And I think that's a lot to do with times right now. There's so many things going on, and we give our prayers out to the rest of the world, things people are handling right now. And then, of course, this is a gorgeous photo. Of course, the monk seal with the outrigger canoeing being the official team sport in Hawaii. And he's taking a breath along with having his long day of ocean activity. It's a gorgeous photo of this one. And then, of course, what the world needs now is aloha, sweet aloha. Yeah, everyone needs that in their life. But thanks again, Duncan, for coming. Really appreciate it. And I look forward to chatting with you before the end of the year again, and see what's going on in the financial world. Much aloha.
Always my pleasure.
Have a great weekend. Yep.
Okay, take care. You too.